Hi, my name's Corey. I'm a CPA and subject matter expert in financial accounting. And in this video, we're going to discuss the financial reporting process. In order to get an understanding of what financial reporting is, we'll start off with a brief explanation of its objectives and purpose. Next, we'll dive into the preparation and purpose of each of the principal financial statements. Developing an understanding of the financial reporting process is extremely important for all users of the financial statements. So let's dive in. Think about a time in the past when you or a family member had a medical test done. How did you get the results? Maybe you received a medical report, or had the results communicated directly to you from the doctor. Either way, the goal would be for the information to be reported to you in a way that you can understand and that you're able to trust. These are the same types of expectations that investors, creditors, and the public have when it comes to a company's financial reporting process. Financial reporting provides valuable information to the users of the financial statements to assist them in making important business and investment decisions. Let's start with the purpose or objective of financial reporting. The principal purpose of the financial reporting process is to provide the users with information about a company's financial health so that they can make investment and credit decisions. In order to make these types of decisions, the users rely on a company's set of financial statements, including their balance sheet, income statement, and statement of cash flows. Through the process of preparing and presenting this information, a company can convey information about their economic resources, operating performance, and cash flows. This gives investors and creditors the ability to use past financial information to make a present investment decision with the goal of earning a future return on their investment. But how do users of the financial statements know that the statements are free from any manipulation and that the information is reliable? Well, in order to ensure that companies follow a consistent approach to reporting their financial information, the standard-setting bodies have defined 6 qualitative characteristics of financial reporting. Let's briefly touch on the first 2 fundamental characteristics, which are relevance and faithful representation. Relevance implies that the information reported in the financial statements should be useful in the decision-making process, meaning it has predictive value. This means that if I'm a user, I should be able to use these financial statements to form predictions about the outcomes of future events within the organization. Faithful representation means that the financial information is complete, neutral, and free from error. This means that as a user, I can be reasonably certain that all necessary information has been reported, it's free from management bias, and it's as accurate as possible. Now that we have a clear understanding of the financial reporting principles, let's talk about a common misconception. Now, while it's true that companies must follow these basic principles when preparing financial statements, not all companies have to follow the exact same set of reporting guidelines. There's various reporting structures that companies can choose to follow depending on factors such as the nature of their business, the size of the organization, and whether they're public or private, as well as their location. While some larger organizations follow U.S. Generally Accepted Reporting Principles, or U.S. GAAP, others follow International Financial Reporting Standards, or IFRS. Depending on the particular framework they use to prepare their financial statements, there may be some variations in the reporting of certain elements. However, with that said, a company typically needs to remain consistent with their reporting framework for comparative purposes over time. Let's run through an overview of each of the principal financial statements that are prepared as part of the financial reporting process. The first financial statement to be prepared is the income statement. In order to keep the lights on, a business must ultimately generate profit, and the income statement is where users can determine how profitable the company was in a particular accounting period. The income statement can be broken down into 3 key components and follows the formula revenue minus expenses equals net income, otherwise known as profit. In the event expenses exceed revenue, this would result in a net loss. The first section of the income statement keeps track of all the company's revenue, which is the amount earned for selling goods or services. However, it's important to remember that revenue does not equal profit. In order to determine the profitability of a company, we need to take into account all of the operating expenses that keep the business running. Things like rent, utilities, wages, and taxes. The final step is to take all the revenue earned for a period of time, less all the expenses, and hopefully we have something left over at the end of the day, which would be the net income. Once the income statement has been prepared and the company has calculated their total retained earnings, it's time to prepare the balance sheet. You can think of the balance sheet as a snapshot of a moment in time that gives us an overview of an organization's financial health, broken down into assets, liabilities, and owner's equity. Assets are the resources the organization owns, such as cash, land, and equipment. Liabilities are debts that the organization has taken on, such as bank loans, wages owed to employees, or debts owed to suppliers. The last category is owner's equity, which is the value that remains with the owners, including investment that comes into the company and the earnings generated over time. The value of the company's assets must always equal the value of their liabilities plus owner's equity. This is where the term balance sheet comes from, since it must always remain in balance. Now, while the balance sheet tells us the actual amount of cash sitting in the company, it doesn't tell us exactly where the money came from and where it's being spent. This is where the statement of cash flows works its magic by showing us the flow of every dollar, breaking it down into 3 key sections: operating activities, investing activities, and financing activities. Why does this matter? Well, if you were an investor in an organization, wouldn't it be nice to know what the company is actually doing with your hard-earned money? Is it being used to buy new supplies and equipment, or is it being used to pay management's bonuses? Understanding this statement can arm users with crucial information about a company's performance. Anytime we have an accounting transaction where money changes hands, it gets grouped into one of these 3 categories and reported on the statement of cash flows. Financing activities are the means by which a company raises funds into the organization. Usually this would be done by either equity financing, like selling ownership shares in the company in exchange for cash, or the other option would be debt financing, which we can think of as a more typical loan from a bank. Investing activities give external users information about how a company is using their profits and funds that they've received from investors. If a company spends money on a new building, some land, or equipment, this would all fall under a company's investing activities. Last, but certainly not least, are the operating activities. This is the category where all the day-to-day business transactions occur. This includes the revenue a company receives for selling a good or service, as well as the expenses a company incurs to operate the business, such as rent, utilities, wages, and taxes. Once this principal financial statement has been prepared, the company can compile all of their financial statements and package them together to be distributed to their users. And that brings us to the end of the video. The financial reporting process is an extremely useful tool that allows organizations to communicate critical financial information to investors and creditors. Ensuring that the financial information is presented to the users in a timely and accurate manner is of the utmost importance. If you're interested in learning more about this topic or others, please feel free to check out our additional videos on many more related topics.